Mhm. Private video input. Click on that arrow. No, just the only one. Maybe just an announcement to tell people.
Yeah.
Some issues.
So hello everyone. We are experiencing some video difficulties. If you could just give us a while, sort this out. We would be live very shortly.
Click on the arrow next to the video and see if the input has changed. Right one.
Great. Fantastic. So looks like we are live. If we could maximize the screen, we would be able to start. Okay, fantastic. Good morning. A very warm welcome to M-DAQ's Innovation Lab Crawl. It's part of Singapore Fintech Festival 2022. My name is Jeremy, and I'm the GM for Corporate Finance and Strategy and the head of Center of Excellence here at M-DAQ. And I'll be your moderator for today. I'm very, very honored to be joined by the guests here today, where we will be talking about the future of securities trading and execution for global investors. I've got an extremely esteemed panel of guests, and perhaps I'd like to introduce them one by one and get them to say a few words, starting with someone dialing in all the way from London at 3 a.m. in the morning. We are extremely honored and pleasured to have him join us today, Dr. Robert Barnes. Dr. Barnes, please.
Well, thank you, sir. And dear ladies and gentlemen, how do you do? My name is Dr. Robert Barnes, the CEO of Turquoise Global Holdings here at London Stock Exchange Group. My humble background includes nearly 20 happy years at UBS in London, and now more than 9 years at London Stock Exchange Group. Turquoise is the international arm of the London Stock Exchange. Through one connection, investors can access trading securities of 20 countries, UK, Switzerland, Europe, and now the United States, up to 6.5 hours ahead of the US main open. Thank you very much.
Thank you, Dr. Barnes. And then to my left, very esteemed guest. For those of you in Singapore, you may see or know him already, Sam Ree from Endowers. Sam?
Hi, everybody. My name is Sam Ree. It's great to be here, Jeremy and the M-DAQ team. Similar to Robert, I've been around the capital markets for a long time. At Morgan Stanley for 17 years in various roles in Hong Kong and Singapore. My last role was as the Chief Investment Officer and also the CEO of Morgan Stanley Investment Management in Asia, where I ran mostly traditional growth assets and equities, but a lot of experience in the capital markets. So really looking forward to the discussions today. Currently, I'm a co-founder and chairman at Endowers, which is the largest and fastest growing digital wealth platform here in Singapore and across Asia. So great to be here.
So last but not least, Stamos from Product.
Good morning, everybody. My name is Stamos Fukianos. Also been in the industry for about 30 years in different banks, almost always in the electronic trading field. And I'm now for the last 2 years, head of strategic product development at M-DAQ.
So great. As you can see, it's a curated list of panelists where we have assembled perspective from different sides of a trade, from the exchange represented by Robert, Dr. Barnes, from the investor represented by Sam, and from product and solutioning represented by Stamos. Perhaps at this point in time, I'd just like to let you know that there will be a Q&A session at the end of the panel discussion where we'll have a QR code and a link in the URL where you can either scan or type in your questions that can be submitted towards the end of the Q&A. We'll flash that once the panel discussion ends. So perhaps without further ado, let's kick this off formally, where we talk about the future of securities trading. But let's start by taking stock of where we are present today. So in today's landscape, investors can already buy and sell multiple securities in various asset classes in different currencies already. Let's talk about some of the trends that we're seeing as well as some of the pain points that exist today that range from slippage costs or the ability to settle, say, a currency of choice. I'd like to start this off by talking about trends. And maybe I'd like to turn to Dr. Barnes. If you could just share with us, what are some of the trends you're observing from an exchange perspective that you're seeing in Asia and also cross-border trading? Dr. Barnes?
Well, thank you, sir. Well, I'd like to share really two observations and an insight. If we start from the macro perspective, stock exchanges play an important role in the real economy, helping to convert risk capital into working capital. And this contributes to real jobs. Now, this matters to all of us. Why? Demographics. Because, ladies and gentlemen, people are getting older and living longer, which is a good thing. And to provide long-term financial health, most of us increasingly rely on direct contribution pensions. And for this long-term financial health, we are increasingly seeing investors invest in equities to meet these long-term investment returns. Now, the second humble observation from Asia, where our insights at the London Stock Exchange Group are based on the experience of LSEG's recent acquisition of Refinitiv, which completed in the beginning of last year. And this is where our colleagues grew from about 4,000 to 25,000 colleagues, half of whom are in Asia Pacific. And listening and engaging with our colleagues, over the last 2 years, we've seen a very significant growing interest in US securities, even from investors in Asian countries. And I'm sure many in the audience are also recognizing this. In fact, a number of brokers in Asia have told us that more than half of the order flow from domestic investors are in US securities. So this means buying shares like Apple and Tesla and Alibaba, or selling them in US dollars from countries that have different settlement currency of choice. So if these are the two trends, what's the insight? Well, the insight is that investors that can buy and sell with lower costs at the time of the transaction will ultimately benefit from the compounding long-term investment returns. So the simple numerical example is for 100 to invest, for one that's only able to deploy 97 to invest, and someone else that is getting a more efficient buying 99.5 in the same security, that second investor is already ahead of the first one in compounding for the long-term investment returns. Thank you very much.
Thank you, Dr. Barnes. I think that's very relevant to me as a personal investor. I do buy US equities as well, and increasingly looking to diversify that portfolio, not just with stocks, but also with ETFs and funds. On that note, I would like to hear about some of the pain points. We talked about some of the trends we've observed. Sam, could you tell us a bit more about some of the pain points and friction that institutional investors are facing today? I mean, they can buy and sell securities, but what exists today that is can be improved?
Yeah, no, it's a great question. And I think if you really boil down to it, I mean, the two key problems that exist is one of access and the other one is of cost, right? I think that, retail investors and institutional investors clearly are very different in the way they gain access and, the level of cost that they can achieve. I think for retail investors, there's been a lot of progress from traditional, in Singapore, actually, I think it hasn't been that long since we can access US equities. For example, like Turquoise is, now providing that service, but, and then there's also new technology players that are providing some fractionalizing of stocks as well, which makes it easier for retail investors to access. But for institutional investors, I think the problems are very different. Institutional investors have huge scale, so they get access and they have, preferential treatment in terms of cost in the brokers, services, and execution services that they have. They also have a lot more technology. So they have internal technology. At Morgan Stanley, we built our own, order management systems, trading platforms, but we also leverage, other technologies, whether it's, Bloomberg execution or other, execution players. I don't want to name all of them, but there's a lot of means of, becoming much more efficient and lowering cost. But I think one area that has been always difficult has been FX. So as an institutional investor, when I was at Morgan Stanley Investment Management, the operational limitations mean that FX is something that is an afterthought. So, we execute, we do all these trades, and then at the end of the day, they execute FX, and the custodian or the, TA would probably give you the worst FX rate of the day to price that trade of the day and settle it. So I think that, it was just an afterthought. And so oftentimes we would look at the performance attribution as a fund manager and look at it at the end of the day and say, wait a minute, my performance is different from what I thought it would be, because we spend so much money and, improve trading and execution, but then we lose all of it on the FX. So we had, I think, structural problems that are now starting to be solved. And I think the kind of technology that, M-DAQ has brought and Turquoise and LSEG group is, implementing is, I think, a huge advancement in allowing institutional investors and also retail investors to access at lower cost with much more efficient FX, which is a tremendous progress, I think.
It's super interesting for you to say that institutional investors already face this.
Have always faced this
pain point, yeah. So as a retail investor, for me, the FX is absolutely opaque. I have no ability to control. It's not transparent. And as a retail investor, I'm getting the short end of the stick.
Except on the Endow's platform. Just kidding.
Indeed. With that, we actually have Mark Northwood, who was most recently at the UK Financial Conduct Authority and the ex-global head of trading at Fidelity International. He's left us a video to share some insight from the pain points faced specifically by retail investors. If I could now share the video, please.
Hello everyone, and thank you for giving me the opportunity to share some thoughts with you on this important topic. Forgive me pre-recording this, but these days I really need my beauty sleep. I will try to answer this question from the perspective of any investor, but focus a little more on the requirements and expectations of
Oh, 1 second, guys. We are sorting out some technical issues. Looks like we're back.
Increase the volume.
Hello everyone, and thank you for giving me the opportunity to share some thoughts with you on this important topic. Forgive me pre-recording this, but these days I really need my beauty sleep. I will try to answer this question from the perspective of any investor, but focus a little more on the requirements and expectations of a retail investor who does not have the benefit of an institutional trading system with an operations team. And I do have personal experience of the pain points I will talk about. Let's assume that every investor works and holds cash in their home or base currency. They may choose to have multiple currency accounts, which reduces the need for FX when trading, but may add pain from adverse currency moves and the potential for slip-ups when managing positions. The key point is this: when they're trading, investors are primarily focused on getting a good price, then on keeping trading costs low and being confident that settlement will happen smoothly. This broadly aligns with what regulators term best execution obligations when firms execute client orders. The interesting thing is that BestEx has become so focused on the security being traded that the hidden downstream costs and processes can be overlooked. This is made worse by specialization, where a trader is expert in trading certain asset classes, and the entire process is designed around that, including the trading cost analysis, or TCA, in the institutional world. This focused approach fails to recognize the complex plumbing required to settle trades, and may miss the hidden costs borne by investors when FX is executed by the platform provider or custody bank to settle a transaction. This is the main pain point. Let me illustrate how this happens. A trader sets up a watch list of securities and currencies, probably with colorful charts and technical indicators. Then they have a blotter showing their orders in stocks, futures, ETFs, etc. If they are in Singapore and they want to buy Amazon in the US, they set up an order for 50 shares, say, and watch the share price in US dollars, trying to pick a good intraday entry point. They're hoping to save a few basis points. Now, a good platform will automatically select a US dollar-based account when Amazon order is created, if they have one. Of course, this will mean that an earlier FX trade from Singapore dollars to US dollars has already been done by the platform provider with the associated spread already paid. If they buy 50 Amazon shares at, say, $100 from a home currency account, the platform provider will automatically exchange their Singapore dollar cash for 5,000 US dollars at some point after the share trade is executed. The spread on retail FX is typically much wider than the commissions, the bid-ask spread for the Amazon shares, and often than the intraday price moves as well. So the outcome is that a well-timed trade in Amazon sees much of the added value from savvy trading lost to the high foreign exchange cost for actually settling the trade. This is particularly painful with short-term round-trip trades, unwound over just a few days, say. For intraday trades where there is no net settlement of shares, this would be catastrophic, and I would expect traders to make sure that they avoid any trade foreign exchange altogether. Another common pain point is executing switch trades. Sell Amazon to buy Google. If the platform defaults to settlement back to base currency for the sell and the buy trades separately, it incurs multiple foreign exchange spreads unnecessarily. Possible solutions here are 1. Setting up and holding positions in a US dollar account. 2. Setting a preference to link trades or delay FX until netting at the end of the day. This is how many institutional orders are managed, and it is best when the foreign exchange spreads are wide, as with retail orders. Or 3, use CFDs or swaps, which should limit the FX spread impact of trading out of currency. But this incurs additional financing costs if positions are held for longer periods. An interesting future scenario will be where spreads for retail size FX trades tightened to the point where they were substantially less than intraday currency movements, as is the case for most securities these days. I would see the retail model changing to one where any foreign exchange required was executed immediately after each child order fill, thereby creating a true combined best execution. In all the cases I described, there is an opportunity to improve the investor experience by 1, reducing the foreign exchange spreads incurred, and 2, offering flexible order types which allow users to specify whether or not to include an FX component. Thank you.
Well, thank you, Mark. I think 2 points stand out from what Mark has shared. Number 1, there's always this ability to compress that FX spread. And number 2, he used this term that was very interesting, complex plumbing. So in the world today, with this complex plumbing that's already legacy, maybe Stamos, could you share a bit about some of the next generation ideas and technology that can remove such pain points? And then perhaps after Stamos, Dr. Barnes, if you could then weigh in as well, please.
Thank you, Jeremy. I think the first thing to say is that technology has been improving and progressing in each product individually over the years. If we were having this conversation 10 years ago, for example, I would have never used the cloud for trading technology, only for post-trading. There's been a lot of improvement in cloud technology, and a lot of the technology has become cheaper to use, therefore democratizing the availability of such technology. The key thing of what we're discussing now is combining the different technologies from different assets together, because equities traditionally always go first, in terms of latency, for example. Equities lead the way, then you have futures, then you have FX. FX lacks information that an exchange product already has, and therefore makes algorithmic trading a bit more difficult than other asset classes. And you have to make a number of assumptions. So you need technology to make those assumptions and make decisions. But what is happening now is the ability to combine equities technology with foreign exchange technology, with fixed income technology, and produce one result that leads you to execution. But once you execute, you're still able to split that into different booking systems in order to settle the way you should settle. And I guess this is where, Jeremy, you're talking about the complex architecture and the complex plumbing, because these things, there are certain points where they come together and certain points where they have to go separately again.
Absolutely. Dr. Barnes, is this something that, from an exchange perspective, a next-gen tech or solution that, can remove these pain points?
Well, thank you very much. I really like the way that Sam identified the two key variables of access and cost, and how Mark added examples of trading scenarios that experience the pain points of the complex plumbing that you mentioned. And when you think about what does that mean, complex plumbing, it is the trading, clearing, settlement, data, reporting. As a humble market operator of a regulated venue, Turquoise, we try to take a lot of that complexity and centralize the solution once to give the benefit to many. And through Turquoise, investors just need one access point now to trade more than 4,300 securities of 20 countries, starting from 8 a.m. UK time, which last week was about 3 p.m. Singapore time. I think it's probably 4 p.m. now as we just changed the clock. Therefore, what are some of the next generation ideas to build on what Stamos mentioned? Well, when we are trading equities and looking at the access point through a single venue, but then looking at reducing cost, we do have the ability to do the best bid and offer on the central limit order books that most people are familiar with on most stock exchanges. But we are also now offering very potent trading tools to institutions to allow them to trade at the midpoint, to save half the bid offer spread. So both the buyer and seller are fairly benefiting from price improvement. And that can happen through dark pools, it can happen through frequent batch auctions and a number of other tools. But just as much, we are also enabling institutions to do much larger size, because on exchanges, electronically, the trend is to shrink trade size. Consider this: if you have a lot of shares on the bid and someone is hitting it with just a small number of shares in a marketable offer, you get a small fill. Over time, the average trade size shrinks. So here in Europe, where we see the average trade size of less than 10,000 euros per share, that's less than 0.01 million per trade, we often see the ability now to solve the problem for institutions to do large blocks of 20, 25 million at the midpoint, getting buying and selling price improvement. Now, when the institutions are able to do this, there is no delay in reporting, and we are now time stamping to a precision of 1 microsecond. So that's 1/1,000,000th of a second, no delayed reporting. That post-trade transparency becomes pre-trade transparency for the next trade. And therefore, working together with a great innovator like M-DAQ, Turquoise and M-DAQ are starting to visualize the intraday live trading. And when these big institutional trades are there, we're also very keen to empower the end investor with these potent trading visualizations and the same trading tools in terms of accessing midpoint and other features in order to help them get their business done. Thank you.
Wow. These tools you talk about, Dr. Barnes, certainly that sounds somewhat complicated. From a technology perspective, maybe Stamos, you could share a little bit in a simplified form. What is the technology that's behind this? I mean, it sounds like it has to be extremely low latency, high frequency with the huge volume coming through. I'm very keen to hear some views, please.
The first step is the blending of rates of a security and a foreign exchange quote. This sounds simple, but even the rate of updates of different asset classes differs significantly. So how quickly you should update, and if you're presenting it into a graphical user interface, you have to take care of a human being's ability to consume those prices visually, right? Whereas on an API is a completely different ball game. So that's the first thing and the first consideration to design this. Then you move into a combined order book where if you're a Singapore investor wanting to buy shares in the LSE, in turquoise, in sterling or in euros, you are able to leave an order in Singapore dollars. And then the technology will see the combination of foreign exchange updates and equity updates in that combined order book in order to place those orders in the native currency of the exchange and update them as foreign exchange moves. Of course, you cannot do that with every tick. You have to have a tolerance level in order for this to make sense. Otherwise, you will never be able to catch a transaction. So again, there are considerations in terms of tuning up all these things. The one thing I remember we were discussing with Dr. Barnes when we were building this product one day was exactly the education of securities people about foreign exchange, right? Something that Sam previously brought up as well. And I remember, I think the quote, the discussion we were having that really convinced people was, imagine if you could leave an order to buy a stock to a market maker for a whole day at any price the market maker wants. And of course, everybody laughed. That would never happen in the equities world. Nevertheless, equities people do it in the FX world, right? So that paints the picture of, you know, the knowledge we're trying to fill in and also to improve as a utility the way that things happen in the industry. And of course, once you do that, as Sam previously said, you go to a custodian, they can do the FX the same day, they can do it tomorrow, they can do it on the day of the settlement, at which point you start paying forward points. So you increase your costs. So people look at the bid and offer spread, but they don't really look at where the mid is at the foreign exchange when they do it. And they can never get a combined transaction cost analysis report because the two trades are done separately. So just to conclude, the power of this combining of the two trades is exactly your ability to ascertain whether you've done well in your investment and how much slippage you have in the combined asset class as opposed to each one separately. I don't know if that was simplified.
Simple enough for me to
understand. I tried.
Well, I think this technology sounds fairly groundbreaking, and it's probably going to disrupt and change a fair bit of things in the current complex plumbing architecture. Maybe I'd like to ask Sam, how do you see this technology being adopted in the future? Say, if you could speak from the perspective of a buy-side fund manager, given your Morgan Stanley experience, and then maybe I would also like Dr. Barnes after that to then add on from your perspective, how the technology can be implemented from an exchange perspective. Sam?
Oh, great question. I think when we talk about technology adoption and when we try to improve these things, there's a lot of focus on efficiency, which is obvious. There's cost savings that are apparent as well. But I think what's the biggest gain actually is on transparency. And it's something that Jeremy mentioned, opaqueness. You know, Dr. Barnes also mentioned this as well. But the transparency that we gain is actually a tremendous benefit, especially as an investor. So it doesn't matter whether you're a retail investor or an institutional investor, in fact, because what you're actually doing is actually bringing forward the transparency, as we spoke about earlier, from a post-trade, later, you know, execution that you have no control over and probably have no transparency of, and you're bringing that pre-trade. And when you do that, then you're actually trading the right stock at the right price on the right curve on the right chart. So I think that's the most important thing that we gain from bringing that FX, which is a post-trade, into a pre-trade. Because even if you're a retail investor, you're buying Amazon shares, and you thought you bought it at this price and you thought you made money, but then as a Singapore dollar investor, you actually lost money because the currency moved the other way.
Correct. Yeah.
So I think you don't have that transparency beforehand. Very few people have that. And that's an exact problem that not just retail investors face, but actually institutional investors face equally. The other thing I would say is that, where do we put this transparency? Do you put it at the broker who executes for you? Do you do it at the fund manager where I was, post-trade settlements? No, if you can put that on the exchange, which is where everybody actually trades, then it becomes even more efficient and becomes even more transparent. And as an investor, whether you're a retail investor or an institutional investor, you're actually going to be using maybe, one fund manager that uses this technology and has transparency, but all the other fund managers don't, then it's a problem, right? You don't know whether this broker has this technology or it is ripping you off on FX.
Right.
But if you put that on the exchange at source of all transactions, and I think that all exchanges should have this, but, obviously LSEG has the foresight and the vision to execute on this. But, if you can do that, improves transparency and efficiency for all investors, whether institutional or retail.
Wow. So Dr. Barnes, before we turn to you, so if I hear this right, you're saying if this technology is adopted at the fund level, only the fund or the fund house would benefit.
Of course.
At the broker level, only the clients of the broker would benefit. But if it's at the exchange level, essentially everyone that trades to the exchange will benefit from the transparency and the more efficient trade life cycle.
Lower cost.
Dr. Barnes, what do you think of that? I mean, keen to hear your views.
Well, thank you, sir. Well, I really like the way that Sam describes the importance of transparency, because the best way to protect investors is to inform them. And one of the great challenges of exchange initiatives is the network effect. But if we have the privilege as a humble market operator to have the equity world connected to us already, and we have the brilliance of the M-DAQ innovation in FX as a Lego block, we can allow, exactly as you and Sam have just mentioned, a workflow, whether it comes from the institution or whether it comes from the intermediaries, to interact at that central point to engage in the equity of interest, but to add the FX currency settlement of choice. And what we hope to do is to allow a seamless experience from the investor to be able to buy and sell the equity in that currency of choice. And as Sam mentioned, the way that we can work together, Turquoise and M-DAQ, is to showcase the series of prices pre-trade in the currency of choice. So therefore, investors should ask to ensure that their intermediaries or their funds can connect to Turquoise and M-DAQ. Thank you very much.
So actually, Robert, on that note, perhaps the last question before we move on to Q&A, I'd also like to ask you, so how can Asian investors access other markets through, say, LSEG? Now that you talked about it, if this is actually going live, how does one in Asia actually go about trading through LSE?
Well, thank you very much. Well, here at the London Stock Exchange Group, we're very honored that working in partnership with the Monetary Authority of Singapore, the MAS has granted the RMO, the recognized market operator status, to each of the London Stock Exchange and Turquoise. And so what that means today is that if one is part of an investment firm and you're a professional investor, that investment firm can now apply through a single process to become a direct member of the London Stock Exchange and Turquoise. Or the investment firm can use their existing relationships with brokers, maybe global firms that already are members of Turquoise, to get access to us. So the first step is to establish a way to deploy an order onto our order book to then have a selection of the equities. The second component is the way we are working together, and here we are very grateful for having an excellent partnership with M-DAQ and the innovation that M-DAQ is bringing in both the visualization and the design of the architecture as we seek to build this seamless experience of trading composite equities in the FX settlement of choice? Thank you very much.
Super. Very nice and concise answer. So maybe with that, I think we will wrap up the panel discussion and move on to Q&A. Right now, we would be flashing a QR code on screen, as well as a link in the chat box where you can type in your questions to any of us in the panelists. And I will get it on this iPad. So, all right, you would see a QR code on screen. You can scan that with your mobile. Oh, I see a question in the chat box actually. Is there a trend to trade tokenized securities? Oh, you want to take that? Yeah, sure. So the question is there a trend to trade tokenized securities? Let's get Sam to answer that.
Yeah, and anybody else wants to also answer. But you know, we see this trend for a while where we had a lot of people trying to tokenize securities at the underlying company or securities level. And then we've also seen people trying to tokenize funds, private market or public market funds. Now, if you look at the actual workings of why they tokenize and how they tokenize it, you know, exchanges these days are so efficient, whether it's, you know, through technology or just over long periods of time of running exchanges. I feel that trading securities is there's no real friction, you know, whether it's in the cost or the speed or anything you do. Even funds are listed as exchange traded funds, which provide intraday liquidity, you know, pricing in the market, which actually moves ahead of, you know, the NAV of the funds underlying sometimes. So the exchanges have solved the problems of efficiency and cost in every way possible. Why do you tokenize? One of the arguments people say is, well, it's, you know, lower cost or it's you fractionalize, but all of those things are actually available already now. So from my perspective, tokenization is just adding another layer of almost inefficiency to what is already an efficient system. And that applies to securities and that applies to funds. And so, you know, for me, I look at it, a lot of people have tried it, but, you know, I don't really see the benefit of it as an investor or as a, you know, as an operator. But if anybody else has a different view.
Dr. Barnes, would you want to weigh in on that as well?
Yes, I want to fully agree with what Sam has said. We have invested significantly as an exchange to make the trading of shares and funds as seamless as possible. What is interesting about the concept of tokenization is it really requires two things, kind of a legal representation of ownership, and two, a physical workflow that can ultimately lead to a change of beneficial ownership for settlement finality. And in many ways, tokenization is very similar to a depositary receipt. And one of the opportunities we can consider is that while securities, shares, and funds are very efficiently traded through the exchange workflow, there are other really large asset classes that don't currently go through the exchange workflow. So think of property, big buildings, or private companies, voluntary carbon. You know, these types of assets traditionally are traded away from the exchange. But when we consider the significant investments that intermediaries and others have put in the workflow of issuance, safekeeping, and trading, the tokenization, like creating a depositary receipt around an asset that allows the buying and selling, let's say, of a large building that could be fractionalized, it suddenly enables investors and intermediaries to do more with what they have. So I would agree with Sam. I think for equities, it makes a lot of sense to continue with the existing infrastructure, but we do have the opportunity to expand for the other asset classes. What might happen in the future, as we're talking about the future of trading, is that if ultimately you get, whether it's a central bank, digital currency, or you happen to have a stable coin, you can then ultimately have the tokenized asset with the effectively tokenized on the other rail currency, And you can actually bring the settlement times together. So whereas today we're T+2, you can gently bring the industry together to ultimately a T0. But that's something for the future. Thank you very much.
If I can just quickly add, I think the opportunity lies not in the tokenization of securities, but in actually the back office and middle office use of possibly digital distributed ledger technology to bring efficiency. So I think there's a company in Australia called Grow, which is doing that for Vanguard and I think Australia Stock Exchange. So exchanges could maybe enhance and become more efficient by adopting distributed ledger technology for custody or settlement, other areas of the back office, which remain relatively inefficient and where technology adoption has not been as, as advanced, maybe. I don't know about LSEC, but surely in Asia, I think there's a lot of opportunities for that.
Got it. Ooh, we have a number of questions that have come in. There are a few that actually ask quite similar questions. So maybe I'll take this one. When will the solution be available to investors? Perhaps Stamos?
The solution will go live, we hope, in the first quarter of next year. Essentially, though, what we have to say is that investors will have to go through the broker. So what we're not trying to do is to disintermediate the broker community. But we want to give all the tools available to investors in order to incentivize them to execute through the brokers and through the exchange. So we hope Q1 next year.
Q1 next year. And another similar question as well, along the same veins is, Dr. Barnes, this is groundbreaking technology. How do you foresee the uplift in trading volumes when this function is introduced on Turquoise? That's number one. Number two, how can I start trading Turquoise equities in Sing dollars?
Thank you very much. Well, I think as a humble market operator, we tend to look at progress as an equation of motivation plus ability. And we're in the enabling game. So we want to try and design in partnership with the users and with great innovators like M-DAQ, workflows that enable the opportunity such that when the motivation comes, the water can go down the pipe. Our experience has been, as we introduce new methods to buy and sell, or the ability to trade the same security in different places or even earlier, there tends to be a net increase in the overall turnover because there is a wider inclusivity of new investors with new investor strategies, and that adds to the heterogeneity, the diversity of that marketplace. In terms of when can we start trading the equity in the settlement currency of choice, the humble request would be, in the first instance, ask the intermediary to access the venue in the first place with the existing equities. And once we are starting to get a critical mass of those users, particularly coming in from Asia, and particularly, for example, those that want to trade US securities early, that makes it a lot simpler to then add on the addition modules, whether it's with FX settlement currency of choice, or in the future to think of going even earlier in terms of start times. Thank you very much.
Thank you. I am getting a signal to wrap up soon, but I'd like to take one last question here. This is a fairly quick one. Would there be a premium charged to retail investors for access to such tools? I guess Stamos?
There shouldn't be. I mean, from M-DAQ perspective and Turquoise perspective, there is no differentiated pricing. But we expect the brokers to have some sort of competition when they present the service to the customer, and we definitely want to attract retail flow as well as institutional, not just institutional, but some is.
Yeah, maybe just to add on, I think the whole business model of a stock exchange or a stock broker is actually focused on volume.
Volume.
Yeah. So actually, it's not about like taking a bigger spread. That's why we have free stock trading, apps and stuff emerging as well.
Absolutely.
So if we can generate more volume, I think that's a huge incentive. I think more interest, more transactions, more volume. I think that's something that brokers will gain, and you don't necessarily have to price higher to achieve that. So I think that's a great advantage that I think brokers will.
No, super insightful. Thank you, thank you. I guess with that, I'd just like to say thank you very much for joining us here today. We hope that you enjoyed this conversation about the future of trading. It's now time to let Dr. Barnes get back to sleep.
It is beautiful.
Yeah, it's probably close to 4 a.m. now in London. So Dr. Barnes, thank you very much for gracing us with your presence here today and joining the panel discussion. Sam, thank you very much. Stamos as well. For those of you who are YouTube familiar, click like and subscribe at the link down below. Just kidding. All right, we hope to see you the next time. With that, signing off from M-DAQ. Thank you very much.
Thank you.
Thank you very much. Bye for now. Thank you.
Bye-bye.
Bye.
Guys.